Mark Lackey joins us with CHF Capital Markets. And Mark, good to see you again.
Great to be back, Pat.
We're talking oil and natural gas. Where do you want to start? The base commodities? Or?
Basically, Pat, what we were going to talk about today was the fact that really oil and gas service companies. But the last time I was on, the price of oil was sitting around $92. And today, as you can see, we're up over 99. We had suggested oil prices would get stronger as we got into the start of the year, and we felt demand was going to be good for gasoline, particularly in both China and the United States, and that's in fact been the case. So the transportation fuels are doing extremely well. You know, the Chinese are up to 20 million vehicles a year now, and North America, we've come back to 16 million, and Americans are actually driving the volume of miles that they were doing back in 2007. So they finally caught up to the pre-recession driving patterns that they had. So very solid here for oil and gas. We think oil and gas averaged 95 to 105 over the next 2 years, Pat.
Okay, so that's the case for the commodity.
Right.
Give me the same case for the commodity in terms of natural gas.
Well, natural gas, Pat, of course, we last time we were on here, we were sitting at 360. We're a buck higher. Now, as everybody knows, this was an extremely cold winter in North America, so it took down the storage levels, and that's been the key factor, although I would point out that the strength, as we just said, in the auto sector plus in construction has been better than maybe a lot of people anticipated. Those are big users of natural gas. And the other area we're seeing natural gas is, lignite's being phased out to some degree in the United States because it is the dirtiest coal in the production of electricity, and you're seeing some natural gas taking up market share there in terms of electricity production.
Okay, so will that continue, you think, after this cold spell, that there'll be continued demand, or will the price drop back a little bit?
Well, I think, Pat, the price may drop a little bit seasonally, but I don't think it's going to drop much. I think we're going to average closer to 460 because the one thing the cold winter did was really take down those inventories. So there's a big advantage that you're not going to enter the summer where you may have some pretty good demand given the cooling season with the kind of inventory overhang you've had the last 3 or 4 years. So to get back to say even $3.50 or $3, I think it's a highly unlikely scenario given the fact that there's enough underlying demand in the industrial sector, I would argue, and in the electricity sector to keep us from really going back to those levels.
Okay, now you want to play those commodities by using the service companies.
Yeah, because Pat, people forget one thing. Service companies are actually the best leverage way to play, higher oil and gas prices, better than even playing the integrated oils and the E&P companies. And the reason is, first of all, there's not as many of them around, and secondly, their earnings tend to rise pretty dramatically when we get higher prices. That's been true in the last number of cycles, and so I think again you have to choose the right service companies. You have to choose the areas where the best growth looks, and that's what we've done today.
But do they have lower volatility, for instance? So if you're wrong on oil prices, you're wrong on gas prices, and they drop like a stone, do the service companies have more resiliency?
They do have a certain amount of volatility. That's absolutely right, Pat. One of the ways we're trying to get around that today, we're getting people that, while they're small and mid-cap players, they've had pretty good earnings. One company pays a dividend. So your volatility issue is not as bad as if you went into a service company that basically has a little bit of cash and not a lot of earnings. Then you've got some risk. There's definitely no question about it that if you fell back to, say, $85 oil, those companies would be ones that are going to have the higher betas.
Yeah.
So you got to be careful on who you choose.
Okay, so our first one is Bricam?
Bricam, and we mentioned them the last time I was here, Pat, and I went out to Edmonton. I actually saw their steel pipe production plant. Very impressive, state-of-the-art, high-quality operation, and it's a very solid business. But what really excites me about Bricam is they continue to grow in the whole fluids area. And the fluids area, manufacturing wholesale of fluids, is huge growth area that we're seeing particularly in Alberta and Texas because of oil shale and gas shale and the fracking techniques. And the other area that interests me is the fact that the Mexicans are opening up their borders to foreign investment. And I think you're going to see that shale oil that's in Texas and the shale gas actually extends into Mexico. So I think there's some real opportunities for the fluid players. That's one of the reasons I like Bricam. I think there's huge upside here in their revenues and profit growth going forward.
Okay, but what's the downside, especially on the pipe business, because that can be a real volatile business?
It can be, and I think that's the smart part they're doing, is that they clearly are becoming more diversified. By having a bigger percentage in the fluids area, it gives them less risk that they do have a pipeline area that can, as you suggest, be somewhat more volatile. Although I would suggest with all the LNG that we're going to start to move, and the fact is that we need more pipelines given the fact the rail system is kind of maxed out, I think, pushing oil here in the short run. So I really think that we definitely need more pipelines.
Okay. Enterprise Group Incorporated.
Now, this is an interesting company, Pat, because in the last few years, these guys have really been a consolidator. They've gotten into a whole host of areas: oil services, oil field services, construction, tunneling, backhole drilling. I like what they've done because, A, they bought companies in a time period when prices were, quite frankly, lower for the commodities. So they acquired people at times when they didn't wait for the commodity prices to rise. And I think the second factor here, Pat, they're well positioned in two areas: LNG growth and oil sands growth. And where do we think the biggest areas of growth are going to be in Alberta in the future? Those two areas. Clearly, we're going to ship a lot more liquefied natural gas down the road when we get the pipelines in place in order to take advantage of those high prices in China.
When we get the pipelines in place, as we've seen with Keystone, for instance, or Northern Gateway Pipeline for that matter, you get a regulatory freeze.
Yeah, although Northern Gateway did get passed by the National Energy Board. So I think that I think down the road they've got to work out the deals with the First Nations, and I think that's certainly doable, Pat. I've been involved in deals with First Nations in the past, and if you sit down and make sure that people don't feel they're being run over, they're actually relatively reasonable guys to deal with. So I think that something can be done in that regard. You're right, Keystone has been a factor. There have been some other pipelines that have been delayed. I think ultimately, though, people will recognize that you can't be just shipping by using rail and barge. There's limits there as to what you can move. So I think that there's some great opportunity for a company like Enterprise to grow their earnings.
Essential Energy, that's one I don't know.
Yeah, now Essential's an interesting company because they actually pay a dividend. So again, it's another company that for a mid-cap player, I think is a lot less risky than most of the companies you would see in this environment in terms of
what
market
kind of yield
cap.
You're looking at?
4.5%.
Oh, not bad.
So not bad at all. These guys are very big in the coil tubing area. They, in fact, have the biggest fleet in Western Canada.
What's coil tubing?
Yeah, coil tubing is used in various drilling techniques, the coil tubes that go down.
Oh, yeah.
They're also quite big in the fracking area, so obviously fracking of oil and gas, shale. And so I think, again, they're well positioned to grow this company over time and to increase earnings and to increase revenues.
Can you grow a company quickly when you're paying out a 4.5% dividend?
Well, yeah, Pat. I mean, I think that the fact is that their cash flow is quite significant. I mean, if the dividend was 6 or 7%, it might be somewhat different. But 4.5% is not taking up all that much cash. And since these companies tend to really generate quite a bit of cash when the prices are rising, that to me is actually a smart move, because I would think that some of the other companies we mentioned today could become dividend producers themselves down the road.
Okay. Mark, great to have you here, man.
It's great to be here, Pat.
Mark Lackey, CHF Capital Markets. So we're going to take a quick break, and when we come back, we're talking about poll results in Quebec and how they are changing. Don't go away.